Hello, everyone. Welcome back to the Property Playbook. Today, I have my mentor, Bob Baptiste, again.
Hello.
And today, we're going to talk about market predictions on residential and multi-unit investments. So, hey, Bob, how you doing?
Good. Doing good. Thanks for having me.
You doing anything for Thanksgiving?
Well, I'm just going to celebrate at home with the family as I'm accustomed to doing. Fortunately, I'll cook up some goodies, eat more than I should.
You're the chef?
A little bit, yes, I am. I'm in charge.
Nice. Welcome back. So today, I would like to talk about these three topics, okay? So the first thing will be residential financing. The second will be multi-unit investment financing. And the third is how can my clients prosper in this current market? So can you touch base a little bit on the residential side?
Fantastic. Thanks for asking the question. When we look at the real estate market in its general right now, and we also look at financing rates, the financing rates have obviously been on a substantial upward trajectory.
Right.
And quite frankly, we don't know whether the federal government is going to be done with answering, or I should say raising interest rates. They've suggested that there potentially could be another interest rate adjustment and or two before we start to see more stability and then potentially some downward direction. What we know and what we believe is that rates can't continue to stay at these elevated levels for longer durations. Because it puts such a damper on the real estate market, and the real estate is a key component of our economy. Right. So if they continue to raise rates, it's going to be very challenging, I think, for the United States economy to recover. Mm-hmm. And so they're going to need participation in the purchasing and selling of properties, because again, that includes plumbers and electricians, right. Sales of products for sheetrock and wood and flooring and all these other components, which have slowed down rather dramatically because, again, starts, or when I refer to this term starts, what I mean, new construction builds have slowed down substantially because these interest rates are higher. And when builders do this, they try to look for some relief because they, in turn, continue to need to have to move units to keep their business afloat. So one of the trends that I've noticed recently is that builders are actually downsizing the scope of the project that they're going to do. Mm-hmm. They're not building, for example, 3,000 square foot homes. They're building 2,000 square foot homes, where the price points can be slightly lower. If the price point's lower, even in spite of the higher interest rates, it does make it more attainable for consumers to get into these types of projects. Gotcha. Also down in South Bay, they've literally had several thousand units that were set up for construction, which included some low housing projects. Okay. But there were provisions in the agreement from the builders that if economic conditions were favorable, that they could cut back on the scope and size of those projects. And several of those builders have done so. They've scaled back rather dramatically, to the dismay of the local government officials, cut down on the number of units that they're going to be engaging in this process of new construction. Right. Because, again, costs. Yeah. Okay. Now, let's go specifically to the consumer on the residential side. Okay. Now, we have seen interest rates gone anywhere from 7%, maybe even as high as 8% for those who might have more challenging credit. Correct. But we have seen a little bit of a settling down on that as well. Right. So maybe come down 0.25%, maybe 0.5%. But again, I don't anticipate any significant changes in that coming into this last quarter of this year, and then moving into the first and second quarters of 2024.
Because the quarter drop of the last week was more on the bank rather than the Fed, right?
That is correct. Fed did not adjust the rates. Feds have decided to hold tight for now. Right. And, obviously lending institutions only make money if they lend money. Right. So they have to get money into circulation. One way to do that is to gently adjust those rates down to see if that might stimulate more growth in their real estate portfolio.
So it's more on a temporary.
I believe it's more of a temporary basis.
Gotcha.
We're going to need to see the federal government start to soften rates just a little bit.
Right.
And then banks, I think, will obviously in turn follow suit, and that might stimulate more potential transactions in the real estate market. But one thing I can always say, and I want to make sure that your viewers are clear, that they understand, listen, you can never change the location, the neighborhood, the school district that you acquire a house. Right. And even though the financing rate might be slightly higher than you're comfortable with in today's market, right, inevitably these rates, in my opinion, are going to have to come down. And so I suggest to my own clients to say, listen, let's acquire this property because it's the right asset in the right location, fits exactly what our family needs. But let's look at financing terms that might be more favorable for us. So let's do a 3-year term or a 5-year term. Let's maybe look at some sort of an adjustable or interest-only loan program where we can keep those payments slightly lower, knowing that we've secured the right asset in the right location.
Right.
And then when market conditions change, and they will because they always do, then we'll go back and we'll seek more permanent long-term financing.
Right.
Okay, so this is going to be important for all the consumers to understand. You can never change the location of the asset. The most important thing is going to be that location. So if you can find the right property at the right price, don't hesitate to acquire that property in today's environment, right, knowing that in the short term, we believe we're going to be able to go back in there, refinance it, and bring down our payments rather significantly.
Yeah, and this is what we touched base on last episode with Carrie, is that, marry the house, date the rate, is because, finding the right home is a lot harder than financing a home because, you always have that big list of, checkbox that you just want to tick off. And that one, if it's gone, it might be gone forever.
Yeah, exactly. So. You never know. Because sometimes people will live in a house for 5 or 7 years, and sometimes, like my own family, they might be in a house for over 40 years.
Right.
Where my parents occupied the same house for an extended season of time.
Right.
So again, if it's the right property in the right location and it checks all those boxes, acquire that asset today, get shorter term financing, and then look to refinance that property down the road when interest rates start to adjust.
Right.
Fair enough?
Fair enough.
All right.
Now let's talk about the next topic, right? To multi-unit investments. Because right now with rates so high, it's hard to have that leverage to be able to have a very favorable cash inflow on those properties. So what are some guidance, or what do you see the market is trending on that?
Okay. In general, I'm going to talk about my own recommendations to my clients. And in general, what I'm telling my own clients right now is, look, instead of buying a $2 or $3 million asset, let's buy down the size and scope of the number of units that we would acquire. Okay. So normally we're going to come into a transaction conservatively 25, 30, 35% down normally. Mm-hmm. Okay. And what I'm suggesting to them today is let's buy down the number of doors that we're willing to acquire. And instead of coming in at a 30 or 35% down, maybe that's going to support a 40% down payment where we can reduce debt loads. Mm-hmm. If we reduce the debt loads, then of course we're going to be paying less in interest. The good news is that, as we know with inflation, that rents are going to continue to escalate as they have.
Right.
And we'll be able to take advantage of a greater profitability once those several of those increases have been phased in over a season of time.
Okay.
But for right now, again, I'm telling my clients, if we're going for higher density units, and we refer to higher density units, we mean units that are 5 doors or 5 units or more, that's considered a commercial asset. In your traditional 2 to 4 units, you can buy those today with as little as 5% down, which is a recent modification.
Correct.
On an occupied basis. So 2 to 4 units, we're going to get traditional financing. On the commercial side, that's 5 units or more. Buy down the number of units that we're going to consider at this point. Increase our cash position going into the transaction, so therefore we reduce the debt, reduce our exposure to higher payments, and then when market conditions are more favorable, we'll seek longer, more permanent types of financing, maybe a 7 or a 10-year program. But again, if the opportunity presents itself and maybe that asset that you buy for $2 million is worth 2.4 or 2.5 million, then I'm always going to encourage all my clients, and I want you to pay close attention to this, is don't get married to your stuff. If you can get a $400,000 or $500,000 or $300,000 or $500,000 gain on the asset, sell the asset, trade it up via the 1031 exchange, because there's no tax consequence, it's deferred, and we're going to trade that up to a higher density number of doors at that time.
Right.
Okay, so that's going to be important. Don't worry about the financing as much. Buy fewer doors with more down payment. Again, it's always going to be about location, location, location.
So to our third and final topic, right? So how could my clients benefit and prosper from this current market?
Well, that's a very good question, because sometimes people look at the value of assets right now because they're up, as we know,
Right.
and they also look at the value of financing because it too is up as well. But I always believe this: when we talk about buying real property assets, we're talking about buying assets that we're going to acquire over a season of time.
Right.
And for some people, it might be 3 to 5 years. Other people, it might be 7 to 10 years, and for other families, it might be longer. But again, I always say this: whatever asset we acquire today, 10 years from now, we're going to think we robbed the bank, because we're going to make good returns, again, because of inflation. Inflation will continue to grow, which is going to push the value of these assets higher and higher and higher. I'll give you an example. There was a building that I bought literally 17 years ago for $1,650,000, which was a lot of money back in those days.
Right.
But today's forecasted value on that asset is $6 million.
Right.
So you go from a $1,650,000 asset to $6 million. Now, did we improve the property? Yeah, we did, but we didn't improve the property to the tune of over $4 million worth of growth.
Yeah.
This is inflationary. So this inflationary growth is what has brought the value of the asset. Now, not just the asset, but also the rents, because at that same time during the original acquisition 17 years ago, the rental income for all of the units, 15 doors in total, was about $12,000 a month in total.
Yeah.
Okay, and I think that's roughly $800 or so a door, something to this effect. Okay. Now, because of inflation, that same apartment unit is renting out for $2,400 a month.
Wow.
So you go from $800 a month to $2,400 a month.
Yeah.
And these numbers, and those again are inflationary based numbers, right? Those things are going to drive the value of the asset. And
Correct.
as the rental value goes up each year,
Right.
because we want to be diligent investors will pay attention to the market, increase the market rate of that rent as is allowable by law, not to exceed the current amount,
Right.
which is about 5% in most jurisdictions. Depends on where you're living, so be careful to check for other areas like Oakland and Berkeley where they have
Correct.
more stringent rent control provisions. But for some of the outlying markets, we want to make sure we keep pace with those. As the value of the rent in its totality comes in on your asset, so will the value of your property. Because your property value is tied to the
How much you
gross
generate.
rent that asset is going to generate.
Yeah.
So don't be afraid. I tell everybody, don't be afraid to acquire properties. Yes, I bought a property just recently during our COVID lockdown, and my wife thought I was absolutely crazy for buying something during COVID. But acquiring that property and the rents were substantially below market value. We've improved the asset. We've raised the rents now to most of the tenants are paying market rate.
Okay.
And now the value of that property has gone up probably about $500,000.
Wow.
And that's a tremendous growth
Yeah.
for an asset that we have acquired literally less than 3 years ago.
Yeah. That's a big turnaround.
It's a
for
big
sure.
turnaround. Yeah. But more importantly, listen, we're not always going to be tied to the value of the asset, because the equity position in the property, although it's very attractive, doesn't bring us monthly revenue.
Right.
How we prosper is that as these rents come in and as inflation pushes higher and it brings in greater rent revenue, our debt service is going to stay the same for the most part. So if our debt service is going to stay the same and our rent value continues to grow, thus we're going to prosper because we have greater income
Right.
and greater returns on our
The
invested
bigger the
dollar.
gap. Yeah.
Exactly.
Gotcha.
That is correct.
Okay, cool. Well, thank you so much for your wisdom, and I'm looking forward to have you back again, probably after Thanksgiving. So,
Okay.
yeah. So, well, again, thank you for watching. If you like, please subscribe, and happy Thanksgiving.